the negative interest rates around the world are causing the dollar to get even stronger relatively, even though to the pound and the euro and the yen and so on. So how does that, and what is the impact of that?
You think the Fed should cut? Let's start there. Market's not that far from you.
I don't spend a lot of time on it. I just assume that they will be cutting 25 beeps. It's baked into the market of for example, we have a 100% U.S. Treasury fund, no SOL taxes, and it's assuming that already. So 25 is done.
Well, you mean you don't have a point of view whether the Fed should? That's not true.
It is.
I know you have a point of view of whether you think the Fed should cut interest rates or not.
I've been doing the same thing for 55 years, and my own sense is that the numbers are baked into whatever the market tells me on short-term rates. On the 10-year bond, however, I've been very surprised. I was on a show with you in May, and it's dropped again. It's now 206 or 207, and that doesn't fit in with the real GDP growth. However, you got to look at it in a global context, not just the U.S. So I suffered from a case of tunnel vision.
So do you think the Fed is embarking on a rate cut cycle? We going to be with this for a while? And what does that mean for the stock market then?
The stock market's easy to the degree that I'm looking at the future stream of cash flow and earnings, and I'm modeling it at 6 to 8% over the next 10 years. On a global basis, the present value of that supports the multiples of EBITDA that these companies are selling at. So it provides a cushion on the downside at 2%, at 3.3 at the end of October of 2018. That was providing some kind of a headwind. So at 2%, that's an issue. The second part, however, is that it impacts corporate cash flows, because most companies that have pension plans have a discount rate. That discount rate is going to come down, which means that the liabilities go up, which means they're going to have to put more cash into the pension plan for the defined benefits, not contributions, but defined benefits. So there's always a give and take on this interest rate on corporate profits multiples, but the key for me is multiples.
You expect a big surge in the market between now and the end of the year because of what the Fed's doing?
I know there are a lot of elements that go into that, of which Beijing is obviously one. Britain is another one. What is Belgium going to do? So there's moving parts. I think the market's discounting a lot of the upside. What the market is not doing is sector-wise is discounting a new infrastructure bill. We as a country need roads, bridges, and infrastructure, and that'll provide a real good stimulus for a lot of the companies. You do not want to be an elected Democrat or Republican and vote against an infrastructure bill and have a bridge fall similar to what you had in Genoa.
Okay. So, Steph, I turn to you. Market knows the Fed's going to cut tomorrow more than likely. The question is sort of what happens next. What's baked in? Tomorrow's baked in. What else is baked in? 25
is baked in, and I think they can do it, especially with the core PCE at 1.6% today, and also the slowdown around the world. That's obvious. I think the language obviously is going to be important for sure. And then I think we have to get through China PMI tomorrow night and to see if there's any stabilization at all, because remember those numbers have been contracting. We need stabilization there. So that's the second thing that I'm going to be looking for. And then finally, it is corporate profits. It's earnings. Earnings are going to drive the market. If they're good and they're rising and they're going up, the market will follow for sure. And I think
you get multiple expansion?
I don't know. I mean, we've had multiple expansion this year. I think we now need earnings to actually revise higher. And I know several firms out there are revising numbers lower. But I actually think if you look at the economic data in the last month, durable goods, a lot of consumer data, confidence.
All the data today was good.
Well, today was good, but also durable goods was actually better. Yeah, and personal spending, consumption. A lot of things are actually not so bad. So that's why I don't think necessarily this is a rate cycle in terms of what the Fed is going to be doing. I think it's one and done, and maybe they hopefully can get data dependent and watch what's going on in inflation, because that'll be the tell going forward.
So, Chris Hyzy, why then, if things are pretty good, 2,900's fair value, S&P, that's what you say?
Yeah, I mean, markets trade above fair value. They tend to trade above fair value as you're going into the next year, and they're starting to discount things like lower rates. They're starting to discount potentially higher cash flow. Free cash flow is pretty good, and as Stephanie says, they're starting to discount what we believe is an earnings and, dare we say, a profit-driven cycle next year. So fair value is just a point in time, and you're looking at fair value of 2,900. We think fully valued is 3,100. So the problem, I think, in the industry is we tend to look at targets on a calendar basis. But if you go back over the last 18 months, the market's only up 5% or so in 18 months' time. So I look at it on a rolling 12-month basis, and I say if your fair value is $2,900, as you're heading into the next 12 months, what's your fair value then?